It's always helpful to remember technical analysis is a means to an end. It will always just be a tool. And like all analysis and tools, charting is for the purpose of an end objective, which is to have trades and investments with higher profits and lower losses. Just like any other field, technical analysis as an approach and the methods and techniques that comprise it have their own limitations and advantages. As discussed before, technical analysis has universal applicability. It can be used from long to short-term perspectives for charts from a wide range of markets, which are all major reasons why charting is so popular and preferred. Some degree of technical analysis can be applied when there is adequate data on a price chart for the construction of appropriate context of past market events, current developments, and likely influences on future price movement. The keywords here are some degree of technical analysis, because the degree of technical analysis that can be effectively applied will vary depending on how price develops on the chart. Elements of market structure are also taken into consideration. This can include things such as where, when, and how long it takes for certain features to form on the chart, such as trends and ranges. Other factors are more chart-specific in regards to the market and specific sector the chart is from, and the current conditions that are developing. For example, a volatile biotechnology stock chart will behave differently than a stock chart from the consumer staples sector. That will also be different when compared to charts of major commodity futures such as gold or oil. Technical analysis is objective. However, it often has a bad reputation as being a sort of pseudoscience, or worse, a so-called art that is just useless guessing. Unfortunately, this reputation is deserved to some extent. The main reason being that people often use technical analysis techniques with a flawed understanding. Not surprisingly, inappropriate application of charting methods results in significant losses. In addition, when methods are properly applied, they can still lead to incorrect outcomes and losses. This is normal, just like any other field or type of analysis. There is margin of error, but more commonly people get bad results when they don't clearly define the criteria for the methods they're using. So oftentimes people will select analysis techniques, but they won't fully take into consideration all the limitations, especially during dynamic market situations. Though to be fair, some of this can be unintentional when traders and investors are not aware or lack the experience in the limitations of certain techniques. Conversely, mistakes can be made due to unwillingness to learn and admit fault. In other words, an ego that leads to willful ignorance. Those are unfortunate realities, but charting does really shine when clear reference points are used. This mainly refers to foundational elements, such as unambiguous structures that have formed in the price movement. In more concrete terms, this can involve things such as swing points, the position of closing prices, and classic chart patterns such as the double top. Once basic market structures like these are identified, more advanced techniques such as those involving Fibonacci ratios can be applied more effectively. Like all tools, technical analysis is not inherently bad or good. It's good when appropriately applied with clear objective criteria. It's bad when there are errors and losses due to misuse and misunderstanding. That is more a product of traders and investors making poor decisions rather than the actual techniques themselves. Try not to think of charting as a 100% guaranteed success. Instead, it offers higher probability of identifying price moving in your favor. Charting is like everything else that tries to determine future outcomes. It applies certain principles to past data in order to better infer what can happen in the future. Basing analysis on past data is a criticism leveled against technical analysis. But this is quite a silly criticism because unless time travel to the future is possible, all analysis is based on what has happened in the past and what is currently developing. Similar to other areas, analysis about possibilities in the future is made from available data. That is, of course, from the past and present. Complete certainty can never be guaranteed because there are always going to be unknown factors that influence the future. That is why, for example, weather forecasting still has error despite advances in meteorology over the centuries. Or why navigation, whether it be on land, sea, air, or even outer space, still has some difficulty in plotting an optimal course due to unforeseen obstacles and factors that can result in mistaken navigation from time to time. It's quite fitting that technical analysis is also called charting. Well, because price on financial instruments is recorded on a chart, and that has some similarities to how, for example, weather forecasting or navigation tries to plot the course of the future. That is to a large degree determined by past and present developments. So a lot can be revealed about the influences on future price movement, but always remember that even if technical analysis and fundamental analysis are combined and form a high probability of success, success is never guaranteed 100%. There will always be risk when there is potential for reward. It all comes down to probability. Technical analysis is merely a way to find better conditions to enter and exit the market. In most cases, favorable conditions won't always be present, and often the best course of action is to do nothing at all. In fact, traders and investors can often have done the right analysis and applied the correct techniques properly. However, if they are too impatient, they can be entering and exiting the market when the conditions are not in their favor.